Okay, I want you to picture something for a second.
Right.
You're in Manhattan. It's a Tuesday morning. The air's crisp. You've got your probably overpriced coffee in your hand.
Happens.
And you're walking through the financial district. You look up, and the sun is just catching one of those massive glass towers.
Mm-hmm.
Or, okay, maybe you're at home scrolling through Twitter or X or whatever we're calling it this week.
Right. Who knows?
And you see a headline flash by, new AI startup valued at $20 billion.
The classic unicorn headlines. Yeah, you see them every single week now.
Exactly. And you look at these things, the skyscraper gleaming in the sun, the unicorn startup minting millionaires overnight, and this very specific, maybe a little cynical thought crosses your mind.
I think I know where you're going with this.
You think, wow, somebody is making an absolute killing off of this, but then the second thought hits you.
Right away.
That somebody is definitely not me.
And historically speaking, you were absolutely right to think that. I mean, that wasn't you being cynical. That was just you being realistic.
Yeah.
For the better part of the last century, the most lucrative assets in the world, we're talking prime commercial real estate, pre-IPO venture capital, they've been locked behind what I always like to call the velvet rope.
The VIP section of capitalism.
Pretty much.
No sneakers allowed.
Precisely. If you wanted to invest in a commercial tower or get in on the ground floor of a company like, I don't know, OpenAI or Uber before they were household names, you essentially needed two things.
Okay.
One, you needed millions and millions of dollars in capital. Or two, you needed the right phone number in your Rolodex. You had to be what the Securities and Exchange Commission, the SEC, defines as an accredited investor.
Which is really just a fancy regulatory way of saying rich.
It is a regulatory club, and yeah, most of us were not on the list. But today, we are unpacking the story of a company that looked at that velvet rope and decided to take a sledgehammer to it. We are doing a deep dive into Fundrise.
Fundrise. Okay, I feel like I've definitely seen their ads on Instagram. They're the ones with the invest in real estate tagline, right? Usually showing a nice house or an apartment complex.
That's how they started, yes.
Yeah.
But the story is so much bigger than just an app for buying buildings.
Right.
Fundrise is a fascinating case study because it sits right at the violent intersection of regulatory change and technological disruption. As of 2025, we're looking at a Washington, D.C.-based fintech giant.
And when you say giant...
I mean, they're managing roughly $2.87 billion in equity. They've invested in $7 billion worth of total assets.
Those numbers are staggering. Just the sheer weight of that capital is hard to get your head around.
They are. But, you know, the number that really matters to me isn't the billions. It's the people.
How so?
We're talking about over 350,000 individual investors.
Wow. So not just three guys in a boardroom smoking cigars and deciding the fate of a neighborhood.
Exactly. This is a massive user base of regular people.
Mm-hmm.
And the mission of this deep dive isn't just to look at their balance sheet. We want to unpack how two brothers from D.C. utilized a specific and frankly kind of obscure change in federal law, the JOBS Act, to build a machine that allows you, with as little as $10, to own pieces of the World Trade Center.
Wait, really? The World Trade Center?
Or the companies building the future of artificial intelligence.
It's just an incredible journey. I mean, it takes us from a single renovated building in D.C. to a financial powerhouse backed by the likes of Goldman Sachs and J.P. Morgan.
It really is.
So let's rewind the tape. Let's go back to the beginning. Because before they were disrupting Wall Street, the founders of Fundrise were actually deeply, deeply embedded in the world of traditional real estate, weren't they?
They were, and I think that's a crucial distinction. This is not a story of outsiders throwing rocks at the castle walls.
Right.
This is a story of insiders unlocking the gate from the inside. The founders are Ben and Dan Miller. And in the Washington, D.C. real estate world, the name Miller carries some serious weight.
Okay, why? Who are they?
Their father is Herb Miller of Western Development Corp.
Should that name ring a bell for me?
If you live in or around D.C., absolutely. Even if you don't, you've probably seen his work. Herb Miller was a major developer. We're talking over 20 million square feet of real estate.
20 million? That's a city.
He developed Georgetown Park, Washington Harbor. These are truly iconic locations. So Ben and Dan, they didn't grow up talking about baseball or video games.
No.
They grew up speaking the language of zoning, financing, cap rates, and development right there at the dinner table. Ben was actually the president of Western Development, and Dan was a managing partner.
So they had the pedigree, they had the connections, they could have easily just kept doing what their dad did. Call up a bank, get a $50 million loan, build a mall, and just count the profits. Why bother trying to reinvent the wheel? Why take that kind of risk?
Because they saw a flaw in the model. Or maybe they saw a massive inefficiency that just bothered them.
What was it?
Traditional development is incredibly capital intensive. You are constantly beholden to institutional gatekeepers.
The banks.
The banks, the private equity funds in New York. You have to please the loan officer, the guys running the big funds. Ben and Dan, they wanted to flip that entire model on its head. They had this idea. What if we let the community invest in their own neighborhoods?
So buy-in, literally.
Literally. They had this belief that if the people who live near development actually owned a piece of it, the project would be more successful. Think about it. If you own a small stake in the coffee shop building down the street,
I'm going to my coffee shop every morning.
where are you going to buy your morning latte?
Yeah, it creates a loyalty loop.
Exactly. It creates a stickiness that traditional capital just can't buy. So they decided to test this theory out.
And this brings us to their patient zero, right? A project called Makedo.
Makedo. It's a really cool spot, actually, a communal marketplace in the H Street NE corridor in Washington, D.C. You've got retail, a restaurant, a cafe, all mixed together.
Okay.
Now, usually, to fund something like this, a developer walks into a bank with a binder, the size of a phone book, full of spreadsheets.
Right.
But the Millers did something radical for the time, and we're talking 2010, 2011 here. They decided to open the investment up to the people.
And when we say people, we're not talking about hedge fund managers from Connecticut.
No. We mean regular residents, neighbors, people on the street. They raised $325,000 from 175 individual investors.
That's pretty cool.
But the key metric here, the thing that really made headlines, was the minimum investment.
How low did they go?
Any resident of D.C. or Virginia could invest for as little as $100.
$100. That is literally less than a nice dinner out in Washington, D.C.
It was unheard of.
Yeah.
I mean, you have to understand, in real estate private equity, the minimum ticket size is usually $50,000, $100,000, sometimes $250,000.
Just to get in the door.
To drop it to $100, that completely changed the physics of the deal. It democratized the asset class in a way that had never, ever been done before in the U.S.
But wait a minute. Doing this in 2010? That couldn't have been easy, right? You couldn't just put a donate here button on a website and call it investing. The SEC usually frowns on that.
Frowns on it is putting it very, very mildly. The SEC would usually shut that down in a heartbeat and slap you with a massive fine.
Right.
And that is why the timeline here is so critical. Fundrise was founded in 2010 and launched in 2012. This was right before the entire regulatory landscape shifted beneath everyone's feet.
So they were ahead of the curve.
They were effectively hacking the existing system to make Makedo work. They were navigating a complete minefield of securities regulations. They had to file mountains and mountains of paperwork just to take that $100 from a neighbor.
But they were betting on something.
They were betting on a change that was coming down the pipeline.
The JOBS Act.
The Jumpstart Our Business Startups Act.
Okay, let's unpack this. Because I know securities regulation sounds incredibly dry, my eyes are glazing over just saying the words. But in this specific case, it was the magic wand that made the entire Fundrise business model possible. What exactly did the JOBS Act do?
So to really understand why this matters, you have to go back to the 1930s.
Okay.
After the Great Depression, the stock market crash, the SEC created very, very strict rules to protect people. They basically said, Grandma shouldn't be allowed to bet her life savings on some sketchy private company.
Which makes sense. They wanted to prevent fraud.
Exactly. So they created this concept of the accredited investor.
The VIP list we talked about earlier.
Right. And to be accredited, you generally need a net worth of over $1 million. And that excludes your primary home or an annual income of over $200,000.
So a pretty high bar.
Very high. If you didn't meet that bar, you were legally banned from investing in these private deals. The government was essentially saying, you aren't rich enough to understand the risk involved here.
It's kind of patronizing, isn't it? You're too poor to handle this opportunity, so we're going to protect you by keeping you poor.
There's definitely a paternalistic element to it, for sure. But the argument was always consumer protection. However, by 2012, the economy was still clawing its way back from the 2008 crash.
Right.
Small businesses couldn't get loans. Startups were starved for capital. So the JOBS Act was signed. It recognized that this old rule was choking off a vital source of capital for the economy.
So what did it change?
Specifically, the provisions regarding equity crowdfunding created a new, streamlined process. It allowed companies to raise capital from the general public, from the non-accredited investors, without the crushing burden and expense of doing a full-blown IPO.
So it basically said you don't have to be a millionaire to invest in a private company, and you don't have to be a massive public corporation to accept money from regular people.
In a nutshell, yes, it was a massive deregulation effort, and Fundrise was positioned perfectly to ride this new wave.
They had the platform ready to go.
They had the platform, they had the proof of concept with Makedo, and now, finally, they had the law on their side. And they did not waste any time. They went from that little local shop on H Street to one of the most iconic addresses in the entire world.
3 World Trade Center.
This was the moment. This was when Fundrise graduated from being an interesting local experiment to a national player. In January 2015, they announced a deal involving the construction of the third tallest tower at the World Trade Center site in Lower Manhattan.
That is a huge leap. I mean, we're talking about a multi-billion-dollar project, one of the most scrutinized, most symbolic construction sites on Earth. How does a crowdfunding app get involved in that?
They did it by offering tax-free bonds. Fundrise purchased a $5 million slice of the bonds used for the financing of the project.
Okay.
They then took $2 million of that slice and offered it directly to their users on the platform.
And again, I have to ask, was the buy-in accessible? Or was this for the big fish?
$5,000. You could buy a bond for $5,000, and it offered a 5% tax-free gross annual return for 5 years.
That is just wild. Owning a bond in the World Trade Center construction for $5,000? I mean, imagine the bragging rights at a dinner party. Well, that tower over there, yeah, I helped finance that.
It was a marketing coup. It generated massive publicity. And more importantly, it shared that this model wasn't just for renovating a coffee shop. It could be a legitimate part of the capital stack for skyscrapers.
Capital stack. Okay, there's a term we should probably define for the listener who doesn't spend their weekends reading Investopedia.
Right, so think of funding a big building like a layer cake. The bottom layer, the biggest layer, is usually a big bank loan. That's the cheapest money, the senior debt.
Safest.
The safest, yes. Then you have layers of equity on top money from investors that is riskier but offers much higher returns if things go well. Fundrise was inserting itself into that stack, proving that the crowd could sit right alongside the big banks and the institutional players.
And speaking of capital, Fundrise wasn't just raising money for buildings at this point. They were raising money for themselves, right? To build the tech, to hire the team, to keep the lights on.
Correct. And their Series A funding round was, for the time, record-breaking. They raised $38 million.
$38 million.
At the time, that was more than any other crowdfunding company had ever raised. It wasn't even close.
Who was putting up that kind of cash for a model that was still pretty new?
It was a very interesting and very strategic mix. The round was led by a company called Renren.
Renren, the Chinese social networking company, like the Facebook of China.
That's the one. Renren invested $31 million of that $38 million total.
That seems a little random. Why would a Chinese social media company want to invest in a DC real estate platform?
It seems random now, but at the time, Chinese tech giants were aggressively diversifying into global fintech. They saw the potential of this model, maybe even before a lot of U.S. venture firms did.
So they saw the future.
But what's just as crucial is who else was in that round. They had heavy hitters from the U.S. real estate and finance world. Guggenheim Partners invested.
A huge name.
A huge name. You had executives from Rockrose Development and Forest City Enterprises, 2 massive real estate players.
So you have the big tech money from Renren, and then you have the establishment money from Guggenheim and Rockrose. That is a powerful seal of approval.
It was total institutional validation. It told the entire market, this isn't just a toy, this is real. By February 2015, they had commitments for another $100 million from institutional investors to put into their real estate offerings. They were flush with cash, and they were ready to scale up.
And scaling meant inventing something new, because buying a specific bond for a specific building is cool, but it's hard to build a diversified portfolio that way, right? If I, the user, have to pick every single building I want to invest in, that takes a lot of time and research.
Precisely. And that friction that I have to read 50 documents just to buy one bond problem led directly to their biggest innovation yet. The eREIT.
The Electronic Real Estate Investment Trust.
Launched in December 2015, this was the world's first ever online REIT. and it was launched under Regulation A plus C, which is a specific part of the JOBS Act that allows for even larger capital raises from the public.
How did this change the user experience? What did it do for me as an investor?
It simplified it dramatically. Instead of picking one single building, you just put your money into the eREIT.
Yeah.
The eREIT then goes out and buys a whole portfolio of properties all across the United States. And the minimum investment, it dropped to just $1,000.
So for $1,000, I'm instantly diversified across commercial real estate nationwide. It's kind of like a mutual fund, but for buildings.
That's the perfect analogy, and the demand was immediate and overwhelming. The first eREIT had a $50 million offering cap.
Okay.
They launched a second one in February 2016. By December of 2016, their income eREIT became the first company to ever raise the maximum $50 million allowed under Regulation A.
So they were maxing out what the law literally allowed them to do.
They were pushing the limits of the regulation, quite literally. They were proving that the retail investor had an appetite for this product that Wall Street had just completely underestimated for decades.
And then they kept expanding on this idea. In 2017, they launched the eFund.
Yep, the eFund.
How is an eFund different from an eREIT? They sound similar.
They do, but they had a different focus. The eREITs were mostly focused on commercial assets or income-generating properties, things like shopping centers, apartment complexes that already existed and were paying rent.
Okay, stable income.
Exactly.
Yeah.
The eFunds, like their first one, the Los Angeles eFund, were focused on for-sale housing in major cities, so developing new housing stock, building from the ground up. They also introduced robo-advisor services around this time, helping users allocate their money based on their goals. You know, do you want income now or do you want growth later?
It sounds like everything was just going up and to the right, a perfect startup story. But as we know, every startup has its growing pains, or in some cases, full-blown drama. And Fundrise hit a massive snag in 2016.
They did. It was a very significant internal conflict that spilled into the public eye, and honestly, it could have killed the company right then and there.
Wow, what happened?
In February 2016, Fundrise terminated their chief financial officer and a senior accountant.
Whoa. Firing the CFO is never a small deal. That's the person who knows where all the money is. That's the person signing off on the books. What happened?
Well, depends on who you asked at the time.
Yeah.
There were two very different stories. The company alleged that the CFO attempted to extort over $1 million from the enterprise.
Extort.
They claimed he was basically holding the company hostage.
That's like a movie plot. And what was his side of the story? What did he say?
He denied the extortion claims entirely. He claimed that his termination was retaliation because he had reported what he called serious fraudulent behavior within the company.
That is the F word that no financial company ever wants to hear, fraud, especially not in fintech.
It is a nuclear accusation. You have to remember the context, fintech was booming, but everyone was terrified of another Enron or another Madoff situation.
Of course.
Especially with a new model like crowdfunding. If investors lose trust, the platform evaporates overnight. It's a confidence game at its core.
So what did Fundrise do?
They knew this, so they immediately hired an outside independent audit firm to come in and investigate all of the allegations.
And what did the audit find?
The firm went through everything and concluded that there was no reasonable basis for the fraud allegations.
Okay, so the independent audit cleared them completely.
It did. And while it was a very tumultuous moment for them, it's actually a really important part of their history. Fintech companies love that motto, move fast and break things, right? That's the Silicon Valley mantra.
Yeah.
But when you are dealing with people's life savings, you cannot break things. You need rigorous governance. Surviving that scandal, submitting to a third-party audit, and coming out clean, it likely strengthened their internal controls and, ironically, proved their resilience to the market.
It's the classic trial by fire. If you can survive an internal coup and a public fraud accusation, you can probably survive a tough market.
You'd hope so.
So they survived 2016. They have the AREDs humming along. But the real estate market is always changing. And around 2021, Fundrise makes another massive pivot. They stopped looking at office towers and started looking at suburban driveways.
The Sunbelt strategy. This is where Fundrise really demonstrated their ability to analyze macroeconomic data and shift their massive ship accordingly. It's one thing to have a good idea, it's another to adapt.
So what did they see in the data that made them change course so dramatically?
They saw the donut effect happening before it was even really a mainstream term.
The donut effect. I'm hungry, but I'm assuming we aren't talking about pastries here.
Unfortunately not. It's when the city center, the downtown core, hollows out and the suburbs around it get fat.
Ah, okay.
They saw the huge demographic shift. Millennials were aging into their prime home buying years, but they were completely priced out of the big coastal cities. Simultaneously, remote work was beginning to untether people from expensive places like New York and San Francisco.
People were leaving.
People were leaving and moving to the Sun Belt places like Texas, Florida, the Carolinas, looking for more space and more affordability.
So Fundrise decides we need to own the houses these people are renting.
Exactly. They moved aggressively into single-family home development and these new build-to-rent communities.
Yeah.
But to do this at scale, to build thousands and thousands of homes, they needed more than just crowd capital. They needed serious leverage.
And this is where the names on the partners list get really, really big.
This is where they level up. In 2021, Fundrise received $300 million in credit from Goldman Sachs to invest in developing single-family homes in the Sun Belt.
Goldman Sachs. So that is not a small crowdfunding player anymore. That is the establishment giving its blessing.
It is. And then you fast forward to March 2024, and they secured a massive $770 million credit facility from J.P. Morgan to expand that exact same strategy.
So wait, let's just pause on the significance of this for a moment. You have a platform that was built to disrupt the banks, to go around the banks, now taking over $1 billion in credit from the biggest banks on Wall Street.
It is a fascinating evolution, isn't it? It signals a huge shift from Fundrise the experiment to Fundrise the institutional asset manager. Goldman and J.P. Morgan do not hand out credit facilities of that size for fun.
No.
They have unbelievably rigorous due diligence teams. It implies a deep, deep level of trust in Fundrise's ability to identify good assets, manage them effectively, and generate returns. It validates their entire Sunbelt thesis.
And it creates this kind of hybrid model, the equity, the down payment, essentially, that comes from the crowd, from regular folks like you and me.
Yep.
But the debt, the big mortgage that comes from Wall Street's biggest players.
Precisely. And that combination allows them to scale so much faster than if they were relying on the crowd for 100% of the capital stack. It's like capital stack 2.0.
Now, speaking of banks, we saw a very weird economic moment in 2023. Interest rates skyrocketed. The banks all got scared and stopped lending. And Fundrise saw another opening.
They did. This led to the Opportunistic Credit Fund, which they launched in January 2023.
What was the opportunity?
Well, you have to remember the context. The Federal Reserve was hiking rates faster than they had in decades to fight inflation. Traditional banks were tightening their belts, refusing to lend for new development projects because they were worried about their own balance sheets.
So you had all these developers who needed money, and the banks were saying no.
And Fundrise stepped in and said yes. They launched a fund specifically for their accredited investors to provide high-yield real estate-backed debt. In essence, they became the lender.
That is smart. When interest rates are high, it's a very good time to be the bank.
It's a great time to be the bank. It allowed them to capture those higher interest rates for their investors, providing a really strong defensive play while the equity market was wobbling. It showed they could play both offense and defense.
So up to this point, the entire story is about real estate. Buildings, houses, debt for buildings. But the subtitle of this deep dive includes venture capital. And this, to me, is the most surprising pivot of them all. Because dirt and bricks are one thing.
Tangible.
AI code and software algorithms are something else entirely.
This is the Futures Now segment of our story. In late 2022, Fundrise launches the Innovation Fund.
What was the pitch for this? Why should a real estate investor care about tech startups?
The pitch was actually very similar to the original real estate pitch. The most exciting growth in the economy is happening in private markets, and you are locked out. But instead of buildings, they were now talking about high-growth private tech companies, specifically fintech and artificial intelligence.
But why pivot? Was real estate getting boring? Was the Sunbelt strategy not working?
It's not about boredom. It's about where the value is being created in the 21st century. It's about something called the J-curve.
The J-curve. Okay, break that down for us.
So back in the 90s, companies went public really early. Think about Amazon. It went public when it was tiny, relatively speaking.
Right.
So regular people, you and me, got to buy the stock and enjoy all of that massive growth in the public market. Today, it's the opposite. Companies stay private for a decade or even longer. All the massive growth, that hypergrowth phase of a company like OpenAI, happens before it ever goes public.
Right. By the time it finally hits the NASDAQ, the 100x gains have already been made by the venture capitalists on Sand Hill Road.
Exactly. If you wait for the IPO, you might be buying at the very top. Fundrise wanted to give Main Street access to that pre-IPO growth. They argued that a truly modern portfolio needs exposure to technology, not just real estate.
So who are we talking about here in this fund? Are these random, no-name startups?
Far from it. As of 2025, the Innovation Fund has raised over $252 million from around 74,000 investors, and their portfolio includes names that define the current tech landscape. They have a stake in OpenAI.
ChatGPT creators.
They have a stake in Anthropic.
The Claude creators. The other big AI player.
Ramp. Omni. These are what they call their star holdings.
That is absolutely mind-bending to me. So a regular person using an app on their phone that they maybe downloaded to buy a piece of an apartment building essentially owns a tiny, tiny sliver of OpenAI.
Technically, yes, through the fund. It democratizes access to the potential upside of the AI revolution in a way that simply wasn't possible a decade ago. It's the velvet rope being cut again, but this time for the VIP section of Silicon Valley.
And they aren't just relying on their own app to sell this new fund anymore, right? I saw something about a major partnership with SoFi.
Yes, that happened in July 2025. SoFi, which is another massive fintech company with millions of users, began offering Fundrise's Innovation Fund to its own user base.
That's a huge distribution channel. That's putting it in front of so many new eyeballs.
It is. It integrates Fundrise's product into the broader fintech ecosystem. It signals that Fundrise is becoming an infrastructure player. They're providing the investment vehicle that other platforms can just plug into. They are becoming part of the plumbing of private market investing for the masses.
So we sit here in 2026. Fundrise has survived the startup phase. They have navigated a public scandal. They've weathered massive interest rate hikes. They're managing billions of dollars. And they're winning awards left and right. Forbes FinTech 50, Inc. 5000, CNBC's top fintech companies.
They have, for all intents and purposes, built a new type of financial institution.
Yeah.
One that looks very, very different from the banks of the 20th century.
So let's bring it all home. What does this all mean for the person listening to this right now? Why does this story matter to them?
It matters because it represents a fundamental shift in how wealth is generated and who gets access to it. For a long, long time, the stock market, the public market, was the only game in town for the average person. Fundrise and the broader wave of these Reg A+ platforms are trying to let Main Street participate in the private markets, where so much of that early growth happens. It means investing is no longer a black box. You have tools to diversify your own portfolio beyond just stocks and bonds.
But, and there's always a but, it requires a different level of understanding. This isn't a savings account at your local bank.
No, it is not. And that's critical. These are illiquid assets. You can't necessarily pull your money out tomorrow like you can with a stock.
Why not?
Because real estate takes time to build or to sell. A venture capital investment can take 7 to 10 years to mature. The velvet rope has been cut, but the risks of being in the VIP section are still very real. You have to be willing to lock your money up for the long term. You have to have a long time horizon.
That is the trade-off. Access comes with responsibility. You get the seat at the table, but you also have to be prepared to pay the bill if the meal isn't good.
And that raises the final and perhaps the most provocative question for our listeners to chew on as we wrap up.
Let's hear it.
Fundrise started by letting neighbors own their neighborhood shops. It was local, it was tangible, you could see the bricks. Now it lets them own pieces of artificial intelligence and massive complex credit portfolios. As these platforms grow to manage not just $7 billion, but maybe $70 billion, maybe $700 billion, will the distinction between Wall Street and Main Street investors eventually disappear entirely? And if it does the sheer scale of this retail herd introduce new types of systemic risks we haven't even thought of yet? What happens if 350,000 people panic at the same time in a private market that isn't designed for that kind of speed or liquidity?
That is a heavy thought. We wanted access, we got access, and now we have to live with the market dynamics we helped create.
Indeed. It's a brave new world of investing.
Well, thank you for unpacking this with us. It's been a fascinating look at how a change in the law and some ambitious brothers really did change the entire investing landscape.
My pleasure. It was a great conversation.
And to our listener, thanks for deep diving with us. We'll catch you on the next one.